your trading coach. Hey there traders, I'm Lance Beggs from yourtradingcoach.com. Welcome back to our series on price bar reversals. In this video we're going to look at the bearish rejection pattern. Okay, let's begin with the definition of the pattern itself. It will hopefully come as no surprise given the name of the pattern, but the bearish rejection is a bearish reversal pattern. It consists of only one price bar as displayed in the example on the video here. Please note though that the open and close don't have to be in exactly the same configuration as displayed here. We'll look at the open and close in more detail right now. The open and close must occur in the lower third of the price bar range. So if we take the price bar range being from the low to the high here and divide it into thirds, the open and close must exist within the red region here. Provided the open and close anywhere within this area, it meets the definition. So let's look at some examples. This first example is a valid bearish rejection pattern. The price opened here at the tab on the left and closed at the tab on the right, both of which are within the lower third of the price bar range. The second example is also a valid bearish rejection pattern. Even though the close in this case is above the open, which is different from the last example, it's still within the lower third and still therefore a valid bearish rejection pattern. Same here in this example when both the open and the close are at the same level. And to wrap up the examples, we have here an invalid bearish rejection pattern. In this case, the open existed within the center third, and despite the fact it rallied to the same high and low and the same close point, the open was not in the lower third and therefore makes it an invalid bearish rejection pattern. Anyway, I think you get the point there. As long as the open and close are both in the lower third of the price bar range, it's a valid bearish rejection price bar. But this doesn't mean you should automatically enter short whenever you see one of these price bars. We need to consider the context of where this pattern is displaying within the price action. In other words, the setup. For starters, the pattern must occur within an uptrend. Let's demonstrate what I mean by that. We have two options. Either price has been trending up with higher highs and higher lows, and then meets a bearish rejection pattern, at the top of the uptrend. Or a second option, the uptrend could occur within the context of a longer term downtrend. So we have price trending downwards with lower lows, lower highs. And the bearish rejection pattern occurs at the end of a counter trend rally. The point is that the bulls have been in control, rallying the price up towards the pattern in both examples, where it's at the top of an uptrend or at the top of a counter trend rally within a larger term downtrend. And for an even higher probability setup, you would ideally have price rallying up to an area of resistance, with the bearish rejection pattern then rejecting prices at that resistance area. Confirmation of the pattern and the trigger for entry comes through price trading below the low of the pattern, down at this point here. Of course, that can be varied depending on your personal preference. If you're willing to seek less confirmation, you might enter at the open immediately after creation of the price bar. Or if you prefer further confirmation, you might be looking for a close below the low of the price bar. Whatever works for you is cool. Let's look at the psychology now, or the sentiment of the pattern, to see who's in control, the bulls or the bears, and to try to understand why this pattern works the way it does. The bulls are clearly in control leading up to the pattern. Demand is greater than supply, driving the prices higher. The bull's dominance is initially unthreatened by this price bar as price continues to rally higher up to the high point here. At this stage, the price bar has the closing tab up here right at the highs and looks incredibly bullish. However, this is the point where the balance between supply and demand is shifted the other way. At this point, demand has now been overcome by supply. The increase in selling pushes price back down to close in the lower third. The previous dominance of the bulls is looking threatened. As price then trades below the pattern at this point here, we get confirmation that higher prices have been rejected and that we're now potentially commencing a bearish move. Hence the name Bearish Rejection Pattern. The down move is propelled at this point through a further increase in sell orders from those entering short on the break of the low to trade this direction here, and from the longs who tightened their stops up below this pattern are now exiting with their profits. A final point on the sentiment of the bearish rejection pattern. Obviously, the lower the close, the more bearish the pattern. In both examples here, the bears were able to push price to close in the lower third. However, in the first example, they were also able to push it down to close below the opening price, obviously displaying greater bearish strength than in the second pattern, where the bears were not able to close the price below the open. So let's check out some examples. This is the British pound US dollar 5-minute chart. The red line at the top here represents previous support, now turned resistance, at the 1.4920 level. Price has rallied in a quite bullish manner up here, up towards that resistance area. In fact, you could say it accelerated up to the area in quite a climactic fashion. Increased supply at the resistance area was evident through creation of the bearish rejection pattern on this price bar here. Price opened in the lower third, came up, breached the resistance level, and price was then rejected, pushing price back down to close in the lower third. In fact, to close on the lows in this example. Price then traded below the low, confirming the pattern and commencing a downtrend move. The bearish rejection pattern at an area of resistance therefore offered those who were long in the uptrend a great opportunity to exit with profits close to the top, and also offered those who wished to take advantage of the downtrend a great opportunity to enter short close to the start of the move at this point here. In our second example, we have the Euro US dollar daily chart to demonstrate that this occurs on all time frames and in fact all liquid markets. Prices rally up again to an area of resistance, in this case the 1.6 level, 1.60000. You don't get much more round number than that. Price continues the rally, breaching the area of resistance, but then rejecting the higher prices to close lower, forming a bearish rejection pattern at an area of resistance. Confirmation through price trading below the lows of the pattern then commences a downtrend. Awesome stuff, hey, I love this pattern. Okay, so coming up in the next video we're going to look at the bullish rejection pattern, and then we'll follow that up with a number of other price reversal patterns. The open close reversal, the closing price reversal, the hook reversal, the key reversal, the island reversal, and the pivot point reversal. I look forward to speaking with you again soon. I'm Lance Beggs from www.yourtradingcoach.com. Wishing you, as always, many profitable bearish reversal patterns. Unless you're a long-only equities trader, then you probably don't want to ever see them. Cheers.